In the last session, we have learned how to evaluate goodwill under various methods. In this session, we shall learn the treatment of goodwill, that is, how to pass the journal entries when we do a full problem on admission of a partner. When we talk about the treatment of goodwill, we classify this into three major heads. Number one, when goodwill amount is paid privately by the new partner to the old partner. Number two is called as a premium method, which is mainly used when goodwill does not appear in the books of the firm. That means in the problem when the balance sheet is given, goodwill amount will not be given in the balance sheet. And number three is a revaluation method. The very first of that, when goodwill amount is paid privately, no entry in the books of the account, because new partner is paying it privately to the old partners. There is, when goodwill amount is to be taken into books, when goodwill account is affected. When paid privately, remember that entry is not to be mentioned, and that will be very specifically shown in the problem, that goodwill so and so is paid privately. When you see in the problem that the goodwill amount is paid privately, do not pass any entry for goodwill. Next, premium method. When this premium method is to be used, when goodwill does not appear in the books of the firm. That means in the problem when the balance sheet is given, in that balance sheet amount of goodwill is not mentioned. So when premium method is used, in that two parts, when cash brought in is paid through firm's account, and B, when cash brought in is credited to new partner's account. First, let us see the effect. When cash is brought in by the new partner is paid through firm's account. First entry, for transfer of goodwill to old partners in sacrifice ratio. Goodwill is an asset. When you value the goodwill, but obvious the value of goodwill will increase. Increase in goodwill is increase in asset. Increase in assets, we debit. Here goodwill account is debited because that is increase in assets. 2. Old partners account. Old partners account, capital is a liability of the firm. When you transfer goodwill to capital, the capital balance will increase. Increase in capital is increase in liability. Increase in liability, we credit. This is the way how you should remember the entries. Why debit and why credit? You should know the reasons for that. Why goodwill account debit? On valuation, the goodwill has increased. Why capital account credit? When you transfer goodwill to capital, capital will automatically increase. Second, for goodwill amount received in cash. When we receive cash, our cash account will automatically increase. Increase in cash is increase in asset. We debit. It may be either cash or bank account. That depends upon the problem. So whether it is cash or bank, both are assets. Increase in the assets, we debit. That is the reason why we have debited this assets. To goodwill. Now the question arises, goodwill is an asset. Here we have debited goodwill. Here why credit? Goodwill account is valued. Goodwill is raised. Now when we receive cash for goodwill, cash will increase, but that amount of goodwill will decrease. Because say for example, goodwill is 1 lakh. Out of that 1 lakh, new partner brings in 20,000 goodwill. So goodwill value 1 lakh of that 20,000 is brought in. So goodwill we show as 80,000. So but obvious, goodwill will decrease. Decrease in goodwill, we credit. Decrease in goodwill is decrease in assets. These are the two compulsory entries when you find out that when goodwill does not appear in the books and the new partner has brought in cash for goodwill. I repeat, when you find out that goodwill is not given in the books and new partner has brought in cash for goodwill, two compulsory entries, transfer goodwill to capital and then show that cash is received for goodwill. Second case, when goodwill does not appear but cash is not paid through firm's account, it will be mentioned as cash brought in is credited to new partner's capital account. First entry here is goodwill amount received in cash. What then? It is credited to new partner. So what the entry will be? Cash account increases, cash account debit. Credited to new partner, so new partner's account will increase, capital increases, it's a liability. Increase in asset, increase in liability. When goodwill is transferred to new partner's account, the new partner's account will increase in liability we have credited. Now see the next effect. This amount, what is there in new partner's account, we distribute among old partners. For that the second entry. For transfer of goodwill to old partners in sacrifice ratio. Whatever goodwill we have taken in new partner's account on the credit side, now we transfer that to old partner's account. Here, from new partner's account, we take out the goodwill amount. So new partner's capital will decrease. Decrease in capital is decrease in liability. Decrease in liability we debit. And what we do with that amount that we take out of goodwill from new partner's account? We transfer that to old partner's capital account. Old partner's capital account will increase. Increase in old partner's account is increase in liability. Increase in liability we credit. This is what one should remember. I repeat the entry. New partner's account debit to old partners. That is for transfer of goodwill. In new partner's capital account on the credit side, already amount of goodwill is shown. That we take out from new partner's account, so new partner's capital will decrease. Decrease in capital is decrease in liability we debit. And that we transfer to old partner's capital. So capital of old partners will increase. Increase in old partner's capital is increase in liability we credit. Now, in both these cases means when cash is paid through firm's account or credited to new partner's account, if goodwill is withdrawn. Withdrawn means what? Old partners take out their share. Old partners will withdraw. How much is their share? According to the ratio. The sacrifice ratio, what is there? You have distributed goodwill. Whatever is the share, old partners will withdraw that. So, the entry will be old partners capital account debit to cash or bank. In the capital account of the old partners, already we have shown goodwill. That they are withdrawing. So, capital will decrease. Decrease in capital is decrease in liability. We credit. And naturally, when they withdraw goodwill, that means what? Cash goes out of the firm. Cash goes out means decrease in cash balance. Decrease in cash balance is nothing but decrease in assets. We debit. So in this premium method, whenever you find goodwill is withdrawn, one basic entry. Old partners account debit to cash or bank if goodwill is withdrawn. And when we do the problems on admission, if nothing is mentioned regarding goodwill, whether withdrawn or retained, we assume that goodwill is retained in the business. If it is withdrawn, it will be clearly specified in the problem that goodwill amount is withdrawn. If withdrawn, then this entry. Or else two compulsory entries. But one has to be very careful in passing this goodwill entries. Once, how to proceed? See the balance sheet. Is goodwill given? No. Goodwill is not given. That means goodwill does not appear in the books. Premium method. Then see the adjustments. Is cash brought in paid through firm's account or is it credited to new partner's account? Will be mentioned. If not mentioned, is paid through firm's account. These two entries we pass. Transfer of goodwill, cash brought in for goodwill. If it is credited to new partner's account, goodwill received in cash and then transfer of goodwill from new partner's account to old partners. In case goodwill is withdrawn, this is the entry what we pass. Now after this premium method, the next method is a revaluation method. Let us see what are the entries of revaluation method. Revaluation method, the third method. In that, if the new partner does not bring cash for goodwill, and second, when goodwill already appears in the books, In the premium method, when goodwill does not appear in the books, we have seen two parts. When cash is brought in by the new partner, it goes to premium method. When cash is not brought in, it comes to revaluation method. Very simple to remember. If the new partner does not bring cash for goodwill, what first entry we pass under premium method? For transfer of goodwill to old partners, what the entry we have learned? Goodwill account debit to old partners, same entry is to be passed. For raising goodwill at its full value, goodwill account debit to old partners. In the premium method, what second entry we pass? Cash brought in for goodwill is not to be passed, because new partner does not bring cash for goodwill. So if you remember premium method, the first two entries, that's enough to make you understand this part. Premium method, first, transfer of goodwill to old partners. Second, cash brought in, same thing, only cash brought in entry is not to be passed. In that previous method of premium, when goodwill is withdrawn, old partners withdraw that and cash goes out. Why cash goes out? New partner brings cash, that cash is withdrawn. But here, when goodwill is withdrawn, remember that new partner does not bring cash. When new partner does not bring cash, old partners cannot withdraw cash. When new partner does not bring cash for goodwill, neither only old partners can withdraw. Who can withdraw goodwill? All partners. Now, goodwill, here already we have transferred to capital account. So capital account has already been increased. That capital account, what has increased, from that all partners withdraw goodwill. When they withdraw goodwill, capital account will decrease. Decrease in capital is decrease in liability. Decrease in liability we debit. 2. Goodwill account. Goodwill is an asset which has already been valued, is debited. When you withdraw goodwill, obviously, when you withdraw goodwill, your goodwill account will decrease. Decrease in goodwill is decrease in asset. Decrease in assets, we credit. This is the entry. When to pass this withdrawn entries, remember, when premium method, when new partner brings cash for goodwill, old partners will withdraw that cash. Old partners to cash. When new partner does not bring cash for goodwill, all partners will withdraw, not cash, but goodwill will decrease. Here no cash, because cash is not brought in. Now, in this revaluation, the second part, when goodwill appears in the books. Appears in the books means what? It is already given to us in the balance sheet. When the problem is given, which we'll see in the next session, when the problem is given, in that the balance sheet is given. In that balance sheet, goodwill amount, if given, we say that goodwill appears in the books. In that, quickly, 3 cases we should see. Goodwill appears at correct value. Second, whether goodwill appears at lower value. And third, when goodwill appears at higher value. Accordingly, we should pass the entry. Correct value means what? Book value equal to adjusted value. I repeat, book value means the value of goodwill which is given in the balance sheet. Adjusted value means the raised value. The adjusted value is given in the adjustments. We have to compare those two values. In the balance sheet, goodwill is 40,000. In the adjustment, goodwill is 40,000. Book value is equal to adjusted value. It appears at correct value, no entry for that. Lower value. Book value is less than adjusted value. Book value less than means book value, balance sheet, 40,000. In the adjustment, it is 50,000. In the balance sheet above, it is 40. Adjusted value is 50. That means balance sheet value is less. Book value is less. It appears at lower value. And when it appears at lower value, same entry we pass. For raising goodwill, goodwill account debit to old partners, but the lower value amount. Balance sheet 40,000, adjusted 50,000. How much is the lower value? 10,000. This entry will come for 10,000, not for 50,000, because out of this 50, 40 is already there in the books. 10,000 extra goodwill is what we have to record. This entry will come for 10,000. Now, when it appears at higher value, what is goodwill appears at higher value means? book value is more than the adjusted value. For example, balance sheet, goodwill is 40,000. In the adjustment, goodwill is 25,000. Balance sheet goodwill 40,000, book value 40. In the adjustment 25,000. That means in the balance sheet the value of goodwill is more by 15,000. That 15,000 is called as higher value of goodwill. For that 15,000 we should pass the entry, reverse entry, old partners account debit to goodwill as if it is withdrawn, because see, in the balance sheet it is 40,000, but in the adjustment it is 25,000. That means now the value of goodwill must be 25. It's already 40. We have to decrease 15,000. How to decrease? Withdraw that. Old partners account debit to goodwill account. So when we start the problems on admission, one has to be very careful with all these things. Goodwill, I repeat, goodwill amount is paid privately, no entry. Premium method. When to go for premium method? When goodwill does not appear in the books of the firm. In that, when cash is brought in, paid through firm's account. When cash is brought in, paid through new partner's account. Revaluation method. In that, two parts. When cash is not brought in by the new partner, and second, when goodwill already appears in the books of the firm. In that, three parts. Correct value, book value equals to adjusted value. Lower value, book value less than adjusted value. Higher value, book value is more than adjusted value. In this session, we have learned the treatment of goodwill and the various journal entries under various methods. In the next session, we shall learn how to prepare a revaluation account before we start with the problems on main admission. Thank you.